I will push you, but you just dial in, turn your camera on, and push you this time. Good evening, everyone. Before we start, can we do a sound check? If you can hear my voice, can you type in yes or just one in the comment box, please? So, very good evening to everyone that just dialed in. Welcome to Tune Protect Group first ever live discussion. My name is Peter from the Investor Relation. I'm your moderator for today's event, which will be split into three parts. Part number one, it's a short presentation by our Group CEO, Rohit. Part two, it's where we will be clarifying some of the misconception, misinformed posts online about Tune Protect Group. And third part, last part, it's where we'll be taking on live Q&A. So without further ado, I'll invite our Group CEO, Rohit, to begin his presentation. Yeah.
I'm backstage. Okay, okay. I mute. Okay. Hello, everyone. It's my pleasure to be with you. Thanks for taking your time out on a Thursday evening. I think it was only fair to do it after market hours. Um, Basically, this is our effort to reach out to retail investors who have an important role in this company as well. And for you as investors to know what's happening with the company, we have been updating obviously the quarterly results. We spoke at the AGM, and we also obviously have the analysts that we update regularly. We also felt it's very important in this market. The video I think has gone off. In this market, to constantly talk to you so you're aware of what's happening in the market. Okay, so let's move on to the next slide. If you can see. Okay. I think it's very important to throw the story of Tune Protect and who we are and how we have gone through the different phases. I'm fully well aware. I joined, as you all know, in October 2020, right in the middle of COVID. Um, I'm fully well aware that obviously the share has gone through a significant decline over the last several years from IPO. Um, I do want to lay out a few statistics so all of you understand the story better. Our growth of our business, which is measured in net return premium, but for simple language, for some of you who may not understand insurance, it's essentially the premium that the company or the revenue that the company earns and keeps with themselves. Okay. Now that has we grew by 12.3% between 2013 to 2016, and we declined 17.8% between 2017 to 2020. Obviously, the market had several concerns with TPG's survival during pandemic, with AirAsia flights significantly reducing during COVID, and the fact that we depended significantly on AirAsia for our travel business. There was a lot of comments I heard that our expense ratio was simply unacceptable, and a lot of it was down to the fact that we did not retain enough business. I always say Tune Protect is a beautiful bride with broken bones. What I mean by that is we had our strength was front end and middleware, but we had a back end which was very outdated. In fact, our core didn't even have a source code. It is 40 years old. Um, Amalgamation of various acquisitions. And we were far from being a customer centric organization. In fact, we had negative NPS in 2020. Obviously, we haven't paid dividends since 2020, and we reported an underwriting loss in the first half of the year. So, obviously, some of this may sound very difficult for all of you to accept. I joined in October 2020, and in January 2021, after the board approval in December 2020, in January 2021, we announced to the market, it's available on our website, a 3-year strategic plan. I always said we have to go down to go up because it's a fundamental transformation that we are aiming to do. We gave 8 KPIs to the market, and you will be happy to know that your company has been reporting every quarter consistently on these KPIs, and we haven't changed the KPI or the strategy, unlike some of the comments we find online. Okay, moving on. Your company is very clear that we cannot do what traditional insurers do. So we do not have a material bank assurance partner or a large agency channel that we can speak to the typical insurance customer, which is mass affluent and affluent customers. So who we want to position is millennials and Gen Z, people who are within 20 to 45 years old, people who are a lot more open to buying online, people who are frustrated with insurance today, people who find insurance expensive, complex, and difficult to understand. And we believe this is where we can digitally disrupt the market. When we studied the Gen Z and millennials, if you move to the next slide, there were three things that mattered to them. The first was the mobile phone, Second was they were ready to travel. A lot of their planning was around the mobile phone. So things like gadget protection, e-wallet insurance mattered a lot to them. The second was they were heavily focused on travel. They love travel, COVID or no COVID. And the third was they were very health conscious in an Instagram, TikTok generation. And we felt there was a material opportunity to provide bite sized insurance targeting these segments, direct to consumer and through digital partnerships, which some of the larger players simply cannot because A, their technology is not there, B, they're not digital insurers, and C, more importantly, is they have material distribution channels who will not allow them to make those transfers. So, this is how we've been differentiating ourselves in the market. Now, moving on to the next slide. So, we came up with a 3 year strategic plan, which was 2021 to 2023, where we said we want to do three things. The first one is we want to build an insurance company that people love. Very important to understand. You might think, what's so great about this? Insurance in general is one of the least trusted industries in many countries based on many studies. And we are now saying we want to build an insurance company that's built on trust. We want to build an insurance company that people love. You look at a lemonade in US, they do not talk about being the number one insurer. They instead talk about being number one on customer satisfaction. That's kind of what we want to do as well because we believe as consumers love us more among our preferred segment, they will buy more from us, they will stay longer with us, and so on and so forth. The second one is we want to build a partnership ecosystem within AirAsia because, as you know, AirAsia is also doing non travel business. But we also want to build our digital partnerships outside AirAsia. And you'll be very happy to know that your company has signed up 60 over partners at this point in time. This was three. The number of partnership was three in 2020 October. We in 2 years are now at 60 over partners, and that you can see in a lot of the numbers as well. The third is we believe with our tech and also our proposition, we can expand this offer to several other markets and build an ASEAN based insurer. There are three key pillars which we want to focus on based on the earlier consumer slide that I showed you. We want to focus on lifestyle. Lifestyle is travel, PA, motor, home, etc., which the consumers want. E-wallet protection. I want to reiterate, we don't want to move away from travel. I want to reiterate, we don't want to depend only on travel, which means we want to diversify our portfolio. Travel is important, but we do not want to depend only on travel. Health, which is bite-sized critical illness, bite-sized health, bite-sized dental plan, etc. And the other is SME because millennials are growing in this. Moving on to the next slide. We made 8 commitments to you. The first commitment, and I'm very happy to report on this for the record, every quarter has been reported since I announced this. You can find it on our website, and your company has been consistent as against some of the comments we see on social media. We have not changed any of our commitments. First, we said we want to grow between 25 to 33%. Your company is growing at 90 plus percent this year. Find me another insurer who's growing at 90 plus percent. You should be very proud to be a shareholder of a company who is growing so high, in a lot of ways defining the future of insurance. We committed that we want to retain upwards of 70% in all our lines of business. What do I mean by that? Earlier, our problem on the expense, which I commented, was because A, we were declining by 17% pre 2020 when I joined. B, we were retaining only 30 odd percent, 38%, which means your denominator is not enough to take care of the expenses. And this problem doesn't get solved by just cutting expenses because, on the contrary, we have to invest in the business and we still need several roles and so forth. The key was A, grow the business, and B, retain more and not just pass it on to reinsurers so that we do business which we should be doing. You will be very happy to see our retention ratio has moved from 38% to 57%. Our expense ratio has dropped significantly. You'll see it in the next slide. And if you look at our combined ratio, over net written premium, not net earned premium. Because as you all are aware, our business growth has been very strong, because of which our premium has not flown through fully. What happens in insurance is your commission you have to pay upfront, but your premium you earn over 12 months. So when you have a very high growth year like this, you have a certain natural adjustment that is happening, and we have to be patient about it. We want to evolve our tech arm as a profit center. We have three new markets actively paying for using our tech. We are growing ASEAN business. We have business in Cambodia. We have business in Indonesia. And as you would have seen in the numbers with the first half, we also grew our Vietnam business, and it will continue to grow as I've committed before. Moving on. We want to be a mobile first company. I think you cannot find another insurer with so many products on the mobile phone. You can buy it very simply. I'm very happy to tell you your company's customer satisfaction has gone up from -16 to +38, which puts us on the top, if not the topmost in the industry. Our employees are getting younger. We're hiring more Gen Z. We're hiring more tech. We're converting more interns, which means our employee base is getting younger. And sustainability is at the core of what we do. Your company is the only insurer in the FTSE for good. We are zero paper. We have made several commitments around sustainability, and I'm very proud to say that as an investor, you're investing in a sustainable brand in today's world. That is such an important area. Moving on. So you can see the 8 commitments we have stuck by it. Now, let me address each of the challenges I talked about when I took over the role. Stagnant growth. We were declining at 17.8% between 2017 to 2020. We are now growing at 91.3%. Last year was my first year. Obviously, I was fixing a lot of things along with the team. We grew at 19.5%. This year, we're growing at 91%. I hear a lot of comments about can TPG survive? I want to be very clear that our capital adequacy ratio is well above 300%, which means your company is not even close to being a PN17 company, is not even close to having a survival question. The statutory regulatory requirement is 130%. The minimum threshold is 180, and we are significantly above. So for those who are sharing these rumors on various social media sites, I want to dispel it that you are selling bogus. We are significantly well capitalized. Overly dependent on travel business. Travel business is 16% today versus 35% in 2019. Very important to realize we are growing at 90%. With AirAsia not back to its full capacity, and when AirAsia comes back, can you think of the benefit that we're going to get next year when AirAsia comes back into its full capacity? Pre-COVID, AirAsia was 90% of our 35%. Today, AirAsia is 15% of travel, which means AirAsia is less than 5 to 6% of the total company's portfolio, which means there's a lot of opportunity upside, but also we've reduced our reliance on just AirAsia. High expense ratio, I keep hearing this. Our expense ratio has dropped 9 percentage points, and we will continue to drop this because what's happening is while our expense grew by 20 plus percent, our top line grew by 90 plus percent, which is a pretty healthy ratio if anybody asks me. We had an outdated core system. I talked about it. We are the first insurer to host core system on the cloud. We just went live with our first phase of our core system, and we'll be completing it by the middle of next year. By when we'll be probably the only Malaysian insurer with such a new age core. So you can imagine how we can be a lot more, progressive and forward-looking. We are far from being a customer-centric in the past. You have seen our customer NPS has moved from -16 to +38. Yes, there was an absence of dividend. Last year we were loss-making, but year before, a lot of last year came from Thailand as well as investment. Year before, we were preserving cash for expansion and growth. And I understand your challenges around underwriting losses, but I strongly do believe a lot of that is because the premium hasn't flown through as yet. And we will explain that as you have questions. Okay, let's move on. I'm very proud to say our customer NPS of plus 38, you can see, even versus some other top five insurers who are at plus 22, plus 10, and plus 23. So you can see we are already one of the more aggressive insurers in terms of customer satisfaction. If you look at our CX metrics, we have 3.1 million, 1.5 million customers, unique customers in first quarter and 1.6 in second quarter. Our average policy per customer is increasing, which means they're buying more from us. They are also staying longer with us. Yes, the average premium is reducing because we are looking at bite-sized, high transaction, simple products. Okay, moving on. So, as I said before, we were the first insurer to obtain cloud approval from B&M. We've gone live with our first phase of cloud. Our core system is also live, and you're going to see a lot more efficiency, speed to market that you are going to see in the days to come. Moving on. Our mobile app, we will be launching a next phase of our mobile app. You all must have seen how easy our mobile app is to use. But more importantly, we'll be launching a new phase where we'll start tracking your sleep data, your walking data, and a lot of other health data subject to, of course, the customer agreeing in which level, and this will be in November, which we had mentioned before as well. It's there in our online analyst decks, nothing new, but we are on schedule for November. The idea will be we'll be able to do hyper customization and hyper personalization because we'll have your driving data, your social media data, and your health data, which means someone who's healthier and drives better, we can give a far better discount versus someone who doesn't do the following. Moving on. We have launched a new campaign because Tune Protect as a brand has been largely limited to travel insurance and Air Asia. So we created a whole new proposition around the thumb, around creating that proposition of being a unique insurer, digital first, simplified, etc. You must have seen our funny thumb, cute thumbs around. You will see a building lit very soon. You'll see a lot of activity around this in terms of creating that strong regional but Malaysian born digital insurance brand. And you all know the lot of noise around digital insurance. You don't need to go looking for one. You already have one here in Tune Protect. Okay, moving on. The one that I love the most and the one that I think people have really started turning their heads on us is we have a 333 promise. You can buy from us in 3 minutes. We will respond to you in 3 hours. And once your claim is approved, we'll pay to you in 3 days. And the claim approval can happen the same day, provided your documents are submitted. This is only obviously for retail claims. We also have 95% of our claims in Malaysia, for example, are paid within 3 days upon approval. During flood as well, we did that. But in general as well, 95% of our claims are being paid within 3 days. We launched a new motor claim process where below 3,000, we will actually approve it in 2 hours, subject to terms and conditions. We've launched parametric travel claims in Vietnam, where actually you could even get the claim even before your flight lands because our tech provides that ability. Moving on. So in summary, why I believe still, yes, the bottom line wasn't great, but as you can see, the story is building up towards where we want to go. Why should investors choose Tune Protect? We are the only vertically integrated local general insurer. So we offer you general insurance, we offer you reinsurance, and we offer you a tech business. We have a tech investor day coming up in November as well. So we've talked a lot about the tech business. We have extensive cross-border, so we can activate several markets for a partner, and that's what we're doing with many partners. We are really multi-distribution. We're not scared of any one channel. We are delivering strong growth for you, the highest growth since IPO. Your company has grown the highest since IPO, and it's been driven by digital and e-commerce. We're an extremely customer-centric business, and our ESG credentials are very strong. And we are the only insurance company in Malaysia in the FTSE for Good Index. I shall stop there and take questions.
Okay, thank you, Rohit. So for the second part, we're going to move on to. So we have gathered many questions, comments, discussion online about Tune Protect Group on the internet. Some of them are quite misleading, and we want to take this opportunity to set things straight for everyone's benefit. So we have regrouped them, paraphrased them. Rohit, together with our group CFO Hao, CTO Prasanta, Chief Partnership and E-commerce Officer Janet, we will address them one by one.
Good. Okay, so let's go to the first question.
So first question is on investment. Investment losses will be severe,
How?
unlike to recover in the short term. And insurance is no longer the core business. Fixed income is not the core business.
How? Okay.
Sorry, I'm trying to understand the questions. I don't really think that it sounds like a statement, which I'm not sure that whether you agree with these things. I would still think that basically our business shall remain, and investment is basically a supplementary. I don't know where this statement is coming from, but I do acknowledge that basically we do actually impacted by the volatilities of the market currently. And as everyone knows that basically the current situation affects positions that's impacting the global markets currently. But having said that, basically the core business contributions is still the main contribution to our business, and actually not only investments. Um, in fact, I think they just recently got an approval that basically will be a little more defensive on our investments to better reflect that in our business. That will be more defensive, bringing more of this thing actually towards FTs and also bonds to minimize the volatilities and not really trying to maximize the return in a sense.
Okay. Anything to add? Rohit?
Okay.
Yep. Okay, we move on to number 2 question. It's on our strategic direction. Chumatech has no direction. Pre-COVID, Chumatech wanted to move away from travel. And during COVID, the focus was back to travel and currently wants to focus on health.
Clearly, someone who doesn't understand our business, clearly, someone who's not read, it's very easy to be a keyboard warrior. Not true. In Jan 2021, when the 3-year strategy was first introduced before COVID was at a full blown stage, we were clear on the 3 pillars we wanted to play in, which was lifestyle, health, and SME. Plus, we also said we want to leverage more on the AirAsia ecosystem to continue our growth story. Travel is definitely our forte. We will continue to grow on travel, but we said we can't depend on travel only. We can't depend on, AirAsia alone. So it was never our intention to move away from travel. Travel has and always will be a critical pillar under the lifestyle pillar, but we continue to want to grow other lines of business. The government expects an increase in foreign travelers in 2023 and is planning to spend 200 million towards promotion and marketing. We believe this will definitely help us as a company to grow our business. For the health space, we have a clear strategy. We aren't playing in the same space as the bigger boys. Our value proposition is affordable, modular, and targeting millennial and Gen Z. And what have we learned from COVID? I think the most important lesson is diversification is important. We can't just depend on one line of business. So that's exactly what Tune Protect wants to do. And we will continue to be a diversified business, but travel will continue to be an important part of our business.
Okay, we move on to number 3 on lifestyle insurance underwritten by Chumatech has a cost of 40, but markup to 100 to sell to policyholders, where a big portion of the profit goes to the fintech intermediaries. How many of these fintech will survive in the next 3 years?
A lot of misconception. I'm uncertain how this costing was arrived. I don't see anything like this in my business. What individual terms, fintech intermediaries? I guess you're talking about aggregators here. If you were to compare our prices of our products sold on aggregator platform versus B2B, actually our price is cheaper on B2C obviously because Bank Nigara requires us to give back the commission to the customer. But to grow our business, we have a multi-pronged approach. We don't depend on one channel. It's B2C, B2B2C, and other intermediaries. Internally, we have a rule that products cannot be launched without minimum of 5% margin, minimum. Except motor, which is driven by market factors. For that reason, this question of profit and not making profit does not even apply. These partners earn commission, and these commissions are controlled by regulation again, and our costing. And remember, unlike your big insurance companies, we don't have large bank assurance partners where we've paid an arm and a leg and have to keep looking at how to get that money back. In this case, we don't have upfront payments.
Okay, thanks, Rohit. We move on to questions on PN17.
Okay, extremely distasteful, whoever said this. You clearly don't understand the business. You clearly don't understand the market. You clearly don't understand economics. For a company to enter into PN17, shareholders' fund has to be equal or less than 25% of the total issued and paid up capital. Our issued and paid up capital is 248.5 million, while our retail earnings is 275.9 million. At about 300%, our capital adequacy ratio significantly above the regulatory requirement of 130% or even the topped up regulatory requirement of 180%. We have zero debt. We have zero gearing ratio. Our investment book is at 749 million. And finally, our auditors have not expressed any adverse or disclaimer opinion of the company's audited financial statements and no concerns whatsoever over a going concern has been raised in any of the reports. So I want to repeat, your company is not anywhere even close to these conversations, and this is just bogus.
Okay, thanks, Rohit. We move on to the next questions on the margins of digital partnership, distribution, and razor thin.
I think I mentioned before, margins on AirAsia and non-AirAsia business are all positive. As a rule of thumb, we do not underwrite any business outside motor, which is less than 5%. Travel and PA obviously have far better margins. We do believe strongly in the digital distribution model. If the margins are thin, it's all about building transaction volume and building the size of the company, and this is something we are continuously doing.
So the next question is sales teams are bums.
I take a lot of offense in this to people who say our sales teams are bum. If your sales team performs at 91% growth, grows its partnership from 10 to 60, digital partnership and e-commerce NWP grew 3.6 times, and we recorded the highest NWP since IPO, I would suggest give me more bums like that.
Okay, thanks, Rohit. The next question is on cutting costs. Okay, I think cost cutting is a very short-term measure. As I've said before, we grew at 91%, our expense grew at 20% the bottom line is our sales is growing much faster than our expense, and hence our management expense ratio has improved from 58.2 to 35.2. So the focus should be on growing top line. The focus should be on management expense ratio and not on expense. We have to invest. Your business has to invest to remain relevant, to grow and be a different company in the market. Okay.
CEO left. I haven't left. I haven't right. I'm sitting right here in front of you. Just to be clear, I am the group CEO. Jubin joined us as the CEO of Deep Malaysia, and maybe there was some confusion around have I left. I want to make it very clear that I'm very much here and kicking and pushing us towards the ambition we have as a group.
The next question is on Asia. And
Tune Protect used to be seen as a proxy to AirAsia. It was true in the past where 33% of the business was travel and 90% of that came from AirAsia. But you need to understand that today travel is less than 20%, 90% of our business. and less than 15% comes from AirAsia. So we in fact look at AirAsia very positively, as when AirAsia comes back up to normal levels, that's going to be a big kicker for us.
Okay. So the final question is on insurance no longer mandatory.
I think for travel insurance not being mandatory is the best thing that happened to travel insurance. Because when it's mandatory, people don't travel. When you have rules like masks, when you have rules like getting a approval before you travel, when you have rules like staying in a hotel room for 1 day to do your test, when you have rules like PCR, when you have rules like travel insurance, people don't travel. What happened during COVID was very few people travel, but they all bought travel insurance. What will happen now is a lot more people will travel, and as a result of which, more people will buy travel insurance. May not be all, because obviously you don't have the COVID situation. If you look at our numbers for Asia as an example, it's grown significantly over last year. It is lower than the year before, but that is only to be expected because we are not at full capacity for AirAsia as yet.
Okay, thank you, Rohit. Now we move on to the final part, which is the live Q&A. We'll be taking on those live questions that came in on Facebook and YouTube. We will not be answering any question that is forward-looking on guidance. If you have any questions on customer service, you can always reach out to our customer service hotline or email. You can find them on our website. So for question number 1 that came in on YouTube, Mr. Tai, please update us on the impact of MFRS 17.
So, how do you want to take that question on the MFRS 17?
We have completed the quantifications, I think, of our opening balance impact from IFRS 17 as of 1st of January 2022 impact. We're currently actually undergoing external auditors, Ernst & Young's, actually auditing the numbers. From our prelim assessment, basically we believe the impact is negligible. Basically it's in the range of less than 5 million ringgit to our retained earnings.
Okay, I hope that answers your question, Mr. Tai. Shall we go on to next one? Another question is on Da The exact question is coming from KS. What is the contribution of Da program to Tune Protect top line, bottom line? And what is the impact when there is absence of Da program?
How do you want to take the question on the contribution?
Okay. The non-program basically contributed, I think, more in the line. I think so far by TD to June 2022, we actually sold approximately like 50 million worth of premiums from the non-programs. But the contributions to our bottom line as of year to date in June, I will see that it was just barely break-even as of June, because there's a mismatch, I think, in the recognitions of revenue over our cost. So our premium, we basically would need to earn the 50 million over the next 12 months. Whereas I think our acquisition cost, etc., basically we have to actually recognize that upfront. So having said that, I think we should expect basically Tenang premiums to be flowing through our P&L gradually over the next 3 quarters. When the absence of the non-program,
Let me answer that question. We have continuously found new ways to grow. That's the beauty of our business. We had COVID travel last year, which was very profitable. Yes, COVID helped in Thailand, like many insurers hit us. We found Penang. We are now starting to grow quite a bit on travel through some of our partnerships as travel comes back. Programs like, which are linked to several travel initiatives. So there are, our business growth pipeline is very strong, as you have seen. And we continue to hold to our internal target commitment, which is to grow between 25 to 33%. And we don't see a reason why that should be revised. And in fact, our current view, as we said during the half yearly, was we do believe it will be on the higher side of the 25 to 33%.
There's a follow-up questions on Tenang by Mr. Tai. He wished that Mr. Howe can repeat on the impact on the bottom line.
No, that was for the MFRS, I think. He says it wasn't clear. Did he say the impact is less than 5 million?
Okay.
Okay, I hope you can hear me now. I think what I was referring to on the 5 million is MFRS 17's impact to our retained earnings, which is actually a positive less than 5 million. I think the exact number is about 3 point something. But that, again, as I mentioned, is actually a draft number that is still being audited by Ernst & Young. But I think anyway, it's not going to be significant, I think, with us because generally, as a share company, our work premiums or our business are actually short-tailed. And the impact on MFRS 17 is expected to be small, much smaller actually compared to a life insurance company.
Okay. Thanks, Hao. There's a question on investment. Okay, we have answered that, so we will skip. Another questions from KS. It's regarding
I
receivables.
think on the investment, we can still answer it if someone, despite our answer, is asking the question. Maybe how you can summarize it one more time to respect the shareholders' question.
Okay, on investment fund, I think a couple of points. I think the first one is I think everyone appreciate that basically it's a very volatile market now, I think globally, because it's once, I mean, the history that we are facing a high inflation as well as the risk of a recession, global recessions at the same time. So what management basically have obtained approval with the board is basically to turn more defensive in our investment portfolio. We will be actually switching basically from the 8% I think exposure that we currently have with equities funds into government bonds, which will allow us to have a stable stream of income, as well as basically reducing actually the average durations of our fixed income portfolio from 4.7 to about 2.7 months, so 2.7 years. That will also, I think, further, I think, reduce the volatilities of our investments return in the coming few quarters as well. Yeah. So I guess if in terms of investments, I think the volatility is basically what we are after. It's not necessarily, I think, to mean that it will be a loss position because by removing volatilities, of course, what it means is we are happy with a lower return, but more assured percentage of return as compared to maybe like now, maybe like in the past 2 months, we record high returns from investments when the market actually recover, but the volatility, I think, when the Fed actually made certain decisions on their rate hikes.
Okay, let's move on to the next question.
Okay. So going back to Mr. KS, it's on the receivables from Asia.
I think we got to take this one as well. Yeah. So actually what we see, I think this year in 2022, that we do observe that Asia's aging actually has improved in 2022. In fact, basically, I mean, we understand that basically impairment assessment was actually done based on net flow rate, which is audited by the national auditor. And this year, what we see is a write back of some of the impairment that we previously provided on the Air Asia related accounts. If I remember correctly, year to date, basically has improved by about 3 million. Because of impairment, of course, we actually collected a lot more. So overall, Air Asia's receivable position has improved. And I believe that basically when the border open up, basically when Air Asia allowed to sell, it will actually gradually improve as their cash flow positions improve and when we start spinning again.
Okay. Another question is on product risk. For those new products that have been launched, is there risk that isn't enough claim history to price in?
I think the COVID product in Thailand was a product that, as you all know, I think the benefit we had in Malaysia was COVID wasn't covered because of communicable disease clause. And even in the products which had cashless option, it wasn't used much because by nature government hospitals kicked in. So that's why in Thailand, like many insurers, we were affected. But the book runs off. Primary exposure is till July this year, but the book runs off by the end of the year. But our primary exposure, as we mentioned before, was till July. Now, in terms of product development, we have a very strong, robust product development process. While you see one COVID product in Thailand not doing well, you also need to understand that COVID travel did exceptionally well. Its loss ratio was lower than even the previous normal travel product. You got to look at our success with home, you got to look at our success with health, you got to look at our success with many such products, etc. So we've had our fair share of success. Having said that, we have a robust process. We have a product development process. We have a peer review process at the group level, which looks at both actuarial and product. We have a customer focus group discussion process where the customer reviews the process. We look at reinsurer statistics. When we do products for which we don't have enough expertise, we generally retain lower because the reinsurer retains more, because naturally the reinsurer may have the expertise. In products where we are more confident and we can take it from a balance sheet and P&L perspective, we hold a higher percentage. The COVID product in Thailand was reinsured from post July, but what happened was initially because it was a health product, and generally we retain a material portion of the health product. Obviously, we were exposed on that product.
Okay, thanks, Rohit. There's another related questions on Thailand. Well, we cautious on the TPT outlook.
I think I've mentioned that answer partly just now, that our book is not run off. Material part of the book was till July. However, we do have some exposure towards the end of the year as well. But we have noticed that COVID claims have reduced significantly. We told you the market during the last quarter call that the effect of Omicron claims will taper in July third quarter 2020. The reason for high claims in Q2 is because we cleared our backlogs as well. Um, in general, we saw our number of claims registration reduce from 9,000 in May to 4,000 in June. So we expect the claims trend to continue to go downward as a majority of the policies have fallen off in July. But we continue to remain cautious because we do have an exposure on the COVID front.
Okay, thanks, Rohit. Another questions on tech, the contribution of tech to current top and bottom line. Any timeline?
So you're starting to see some first numbers from us. As we have promised you, by the end of next year, tech will be reported separately to the market. So you will start seeing more and more information around tech. If you look at the last quarter document, you will notice that we've started to give you a little bit more information around tech in terms of what we are doing in tech, where are we focusing on tech, the core system, the mobile app, the policies issued by our system. But in terms of actual financials being given out, we expect to do that next year.
Okay. Just to go back a little bit on the investment, Mr. Tai got a follow-up questions on the
Okay, that's
reallocation
Malaysia
of
bond. It's very clear. I think it's a very straightforward answer. Mr. Tai, we invest only in Malaysia bonds. We don't have government. We don't have US bonds. We do have equity exposure in Asia Pacific up to 10%, as you're aware. But in terms of bond, it's all Malaysia bond.
Okay.
So I would like to reiterate a few messages. If I can open my Tune Protect slide, please. I would like to reiterate a few messages for investors. First, we are not an established insurance company. So please do not look at us as one. Look at us as an insurtech. Compare us with Lemonade, compare us with Policy Bazaar, compare us with Root. That's what you should be doing. You have a Malaysian-based insurtech, so it gives you a different kind of opportunity. It's your own risk and your own personal call, but it gives you a different size or opportunity to invest. We believe we are primed for significant growth. We believe we offer a compelling proposition of being a really unique insurer. Our 333 promise on the customer side. On the partnership side, why has Janet and team been so successful along with Prashanta is very simple. I go to the market and say, if you can find an insurer who can execute faster than me, I'm ready for the challenge. And I hold that challenge even today. Nobody can execute faster than me in Malaysia today. And I think the last component is we are very ESG focused. So we're a sustainable insurer. We're thinking for the future. We are well capitalized. And our growth story continues. Yes, in the short term, we've had some bottom line issues. But as I've always said before, I also said this at the AGM, it's a 3-year story. It's not a quarterly story. I do believe that we are leading towards the promises we have given, the 8 commitments we've given the market for 2023. We are reporting that every quarter. You've seen this year. You'll see it on our website for the last few quarters as well. We haven't run away from any of those promises. Our commitment is 2023, and we strongly believe in what we'll deliver in 2023. Yes, there will be challenges in the short term. Yes, there will be headwinds, but we are convinced that the 2023 story is a very positive growth story.
Okay. On behalf of Rohit and the senior management team, I'd like to thank you for joining us this evening. Our Q3 results will be tentatively on the 25th of November. So if you have any other question, you can always reach out to our team. Okay, there's one more question. It's KS. What is the growth rate of travel insurance, particularly in Thailand and Malaysia and Middle East, for the past few months after the travel restriction have been lifted?
Okay.
I can take you.
Okay. So our growth rate for first half, as you can see from the numbers you have, our growth rate in Malaysia has been greater than 100%. Our growth rate in Thailand has also been greater than 100%. Middle East has declined. The reason it's declined is by 40%, 40 plus percent. The reason it's declined is because once the COVID situation went off, the average premiums came down. Our premiums came down significantly. In fact, we're selling more policies, but our premiums came down. We also have seen a growth of greater than 100% in Philippines, in Vietnam, in Indonesia, as well as other markets. We have been impacted in UAE and Morocco. The reason being the average premiums are coming down.
Okay. Okay, if there's no more question, thank you everyone. Have a good evening.
Thank you. Bye.